charts is going to be our portfolio alpha and beta throughout different points in time over the last 10 years. You're going to see the rolling 63-day beta exposure, the rolling 63-day annualized alpha, and our portfolio metrics relative to the SPY ETF over time. And you're going to be able to adjust the slider to see exactly what that performance is over time. And you can assess effectively your overall market exposure and your alpha. So let's take a look at an example and discuss the implications. So I'm going to go back to maybe 2020. If we go back to 2020, right, we can see that the gray path here is the market path, the blue path is the portfolio path. This is going to be my rolling 63-day CAPM regression. This is what is generating my alpha and my beta. So you can see my annualized alpha here at this particular point in time. Over the last 63 days from this stopping point is negative 0.139% or negative 34% annualized. So we're not doing particularly well with this strategy. Our current beta exposure at that point in time is 0.85. Now, as we continue to move along in time, that exposure is going to change. So if we take a look now at the exposure, we can see that the beta is now 0.65. So the beta has actually gone down, and our alpha has also gone down. So we went from a minus 30% roughly annualized alpha to minus 50% annualized alpha. So we can see here that the beta is going to be roughly between 0.5 and maybe 1 throughout the life of this series. And our annualized alpha is kind of just oscillating between negative 50% and positive 50%. I can't imagine it would be anything statistically significant. I can't imagine on average it being statistically indifferent from zero. But this is overall the information that this particular animation is going to give you throughout the last 10 years. And of course, you can modify your return series. You can modify the script that is going to fetch your portfolio returns from Interactive Brokers to adjust for different time periods. You can adjust your rolling exposure. You don't have to use 63 days. You could use 20. You could do monthly, quarterly, whatever you'd like. And then, of course, you can assess your portfolio metrics down here over time as well. So you can see that the max drawdown for each portfolio is going to change over time. So at the end of this particular series, it was 26 and 33%. The CAGR is 13 and 15%. And you can just see how this is going to change over time. You can see it goes from roughly 0 sharp in Sortino to maybe closer to 1.2 Sortino and barely a 0.8 sharp. So you'll be able to analyze your portfolio relative to the benchmark over the last 10 years. And if you make any updates to your portfolio, you'll be able to just rerun that script, or of course, just generate a new return CSV and plug it right on into this cell. Now, it's very important to understand that you can try to forecast these parameters all you like. There's no guarantee that they're going to persist going into the future. This gets into a broader idea of portfolio construction. What is generating your returns? Are they just exposures to undiversifiable risk assets? Are they orthogonal strategies or return streams? Those are the bigger questions that we have to ask and answer. This is merely just giving you an idea of, assuming that you just have raw exposure to these assets without physical decorrelation, what is going to happen to your portfolio if there is a market crisis, and is your portfolio generating any meaningful alpha? So you can see here oscillating between minus 50 and 50%. Now, there's no way this is generating any meaningful alpha. Moreover, we are quite exposed to beta. If you're targeting a role as a trader, market maker, quant, or you're just looking to grow and protect your portfolio in all market climates by applying quantitative strategy, QuantGuild has 2 crazy free resources available to you. When you get started, you can pick your track. You can always change this later. If you're looking to break in, head on over to the Quant Roadmap. Every topic in the right order that you need to know for success in different roles. You can select them here. It will tell you the exact breadth and depth of knowledge you need in each for success in interviews and the career as a whole. And of course, if you're looking to grow and preserve your wealth, you're going to want to run your own personal hedge fund. This isn't a day trading strategy. It's structure institutions use every single day to cut their downside risk in half, improving their overall long run return. I have a free quant research note available to you on this page for exactly what is going on. Link in the description below to Quant Guild if you're interested in these free resources.